Bonds and their valuations. Bonds are also known as fixed income. A bond is a debt investment in which an investor loans money to an entity, typically corporate or governmental. Debt financing or investment occurs when a firm or government raises money for working capital or capital expenditures by selling bonds, bills, or notes to individuals and/or institutional investors. In return for lending the money, the individuals or institutions become creditors and receive a promise, which is the principal and interest on the debt that will be repaid. Bonds pay fixed coupon payments at fixed intervals and pay the par value at maturity. The coupon is the interest, the par value is the face value, and the maturity is the expiry date, wherein the creditor pays and the investors get paid. Debentures are unsecured bonds. Subordinated debentures are unsecured junior debt. Mortgage bonds are secured bonds. Zeros, bonds that pay only par value at maturity, which contains no coupons. Junk bonds are speculative or below investment grade bonds rated BB and below. These are also called high yield bonds. Eurobonds, bonds denominated in one currency and sold in another country. The bond contract between the firm and the trustee represents the bondholders. The bond contract includes coupons, par value, maturity, which is the repayment provisions, and the restrictive provisions. So how do we value bonds? Before we get to that, what are the different kinds of value? The first one is book value, which is the value of an asset as shown on a firm's balance sheet. This is also known as historical cost. The next one is the liquidation value, which is the amount that could be received if an asset were sold individually. Next is the market value, which is the observed value of an asset in the marketplace. It is determined by supply and demand. Next is the intrinsic value, which is the economic or fair value of an asset. This is the present value of an asset's expected future cash flows. Security valuation. In general, the intrinsic value of an asset is the present value of the stream of expected cash flows discounted at an appropriate required rate of return. Can the intrinsic value of an asset differ from its market value? There is a significant difference between intrinsic value and market value. Intrinsic value is an estimate of the actual true value of a company. Market value is the value of a company as reflected by the market. Therefore, market value may be significantly higher or lower than the intrinsic value. Valuation is the process of determining the current worth of an asset or a company. This can be estimated by adding all the future cash flows and earnings. Now we know the basics. Let's proceed to valuing bonds. We can value bonds by discounting the bond's cash flows at the investor's required rate of return. This can be seen in this formula. First, we need to find the present value of the bond's future cash flows. The present value is the amount that would have to be invested today to generate that future cash flow. Present value is dependent on the timing of the cash flow and the interest rate used to calculate the present value. To figure out the value, the present value of each individual cash flows must be found. Then just add the figures together to determine the bond's price. After you calculate the expected cash flows, you will need to add the individual cash flows. Then add them all together. Basically, the coupon payment stream, which is the annuity, plus the par value payment, which is a single sum. Let's try this example. Company ABC decides to issue 20-year bonds with a par value of $100 and an annual coupon payments. The return on other corporate bonds of similar risk is currently 14%. They decided to offer a 12% coupon interest rate. What would be the fair price for these bonds? Again, the coupon rate is 12%. The par value is $100. the discount rate is 14%, and the maturity is 20 years. We can get the PMT, or interest per period, by multiplying the par value, coupon rate, and the number of periods. In this case, P times R times N is equals to 100 times 0.12 times 1 equals 12, which is the PMT. Now, let's put it in the mathematical formula that was shown previously. As a result, the present value of the bond is $86.7. Comparing it to the discount, the bond is sold at a discount since the coupon is less than the discount rate. In the end, the beauty of fixed income securities is that the investor can expect to receive a certain amount of cash provided the bond or debt instrument is held until maturity and its issuer does not default.